My name is Jake, welcome to the channel. In today's video, I want to talk about a future dividend aristocrat that is growing its dividend over the last 5 years at a 9%. So this company has a 9% CAGR, dividend CAGR, and it's a future dividend aristocrat. They've increased their dividend for the last 20 years. And so if they continue doing this for the next 5 years, they will have the status of dividend aristocrat. So a very prestigious status that not a lot of businesses achieve. And I'm really excited to talk about the company Waste Management. If you're a long-term subscriber of the channel, I've talked about this company for years. Always on my Review My Pie series, I always talk about this company, especially, when you're thinking about industrials and if you're thinking about dividend growth. This is a great business that really checks off a lot of boxes. The thing that I love most about this company is it does well when the economy is booming, but it also does well when the economy is struggling and when we're in a recession. And so that's why I love investing into companies like this, Waste Management, because they're so well positioned. They have such a wide economic moat that insulates them from, outside market conditions. And that's what we're going to talk about in today's video. So I'm going to go over 4 topics. The first thing that I want to talk about is I want to understand the industrial sector, and I want to kind of highlight some of the differences there and just kind of share with you, what to think about when you think about the industrial sector. Then I want to do a deep dive into Waste Management. I want to review the fundamentals. So we're going to look at the PE ratio, the EPS growth, payout ratio, the outstanding shares, how that's gone down over the years. And then I want to talk about the dividend metrics. I want to talk about the portfolio overview. So that's where I'm going to talk about their revenue sources, the business itself. So we'll talk a lot about that, where they're diversified, where they generate their revenue. And then the third part of the video, I want to talk about the bull and the bear case. So for every stock, every investment, there's always risk. There's always upside and downside. And I want to talk about what analysts are saying is the bull case and the bear case for this company. And then lastly, I want to compare Waste Management to the S&P 500. I want to look at the price, the share price, as well as the total return, the dividend plus the capital appreciation. And I also want to compare it to SCHD. So whenever you're comparing investments, I think it's important to have the benchmark, which is the S&P 500, but I also want to look at the benchmark for dividend growth, or, as a dividend investor, I want to compare that to the holy grail, the SCHDs of the world, what that, how Waste Management compares to a dividend growth ETF like that. At the end of the day, Waste Management provides a service that you and I rely on every single day. And if we didn't have a company like Waste Management to take care of our trash for us, our lives would look a lot different. And it would probably look a little like this.
Hello, Mr. George. How much you pay for the new guy? 20 bucks? No, too much money. He's no good operator.
Oh my gosh. Oh man. All right, cool. But a couple of things here before we dive into the industrials that I wanted to share. So here last week, if you're a shareholder of Waste Management, you just got a 7.7 dividend increase. Once again, over the last 5 years, annualized, it's equal to just about 9%. So this company is growing its dividend at a very, very rapid rate. But one thing that I do want to share here, let me zoom in here. Let's see if you can see this a little bit better. There we go. So one thing that I do want to highlight is Waste Management. It's a business that's been around for decades, but you really haven't seen this massive growth, this uptick in growth, except for the last decade or so. So if you've been an investor in Waste Management back in the 1990s, early 2000s, this stock has remained flat. Okay. And it wasn't until a couple of years ago, about 10 years ago, where you really started to see this growth. And if you listen to Warren Buffett, if you've heard any quotes on Warren Buffett, one of his quotes that really stuck out to me, and I'm going to butcher the quote here, but essentially what he says, if you're not willing to hold a company for 10 years, don't even bother holding it for a couple of days or weeks or a short period of time. Meaning, if you don't have a long-term mindset, there's really no point investing into a business. And I was doing some research on this, and I found that it's something that's really interesting. So Bill Gates, love him or hate him, he's kind of a controversial figure in the media now with his ideas and all that good stuff. Leave that all aside, okay? something that really stuck out to me is how he holds his investments, like what his portfolio looks like. Half of his portfolio is in Berkshire Hathaway. I mean, it's kind of obvious he's kind of buddy with Warren Buffett. But his second largest position is in waste management. And that really stuck out to me. And, for years when I've thought about waste management, I've thought about this. There's a reason why Bill Gates has such a large position in waste management, actually 10%. It's his second largest holding. It comes down to that philosophy from Warren Buffett. If you're not thinking in decades, you're not really setting yourself up for success as an investor. And in doing research for this video, I came across this article from the Harvard Business Review written by Bill Gates back in 1996. Now, bear in mind, this was before the tech bubble. This was before, Amazon really started taking off. Like, this was a long time ago. And the article was written by Bill Gates, and it said that what he learned from Warren Buffett. And if you go down into the article and you search for the word decade, and what was interesting here is, once again, bear in mind, this was written in 1996 before Warren Buffett started investing into Apple and all of that stuff, okay? But what he said here was Warren stays away from technology companies because he likes investments in which he can predict winners a decade in advance, an almost impossible feat when it comes to technology, or companies or sectors that are a little bit unpredictable, or where there's businesses that are being disrupted. So for those of you that follow the channel, I work in the technology sector, and I've talked about this many, many times. One of the reasons why I don't invest into software companies or technology companies is because I know how disruptive the industry is. You see just now recently, it's pretty timely with ChatGPT disrupting Google. A month ago, a year ago, people would have said that Google is king of the mountain and they'll never be disrupted. Now it's like people are thinking, is Google going to become irrelevant, because of this technology? And that is why I think it's so interesting. This is why waste management is one of my favorite holdings, is because it's in an industry that is not so easily disrupted, and that it's an industry where you can plan out decades into the future and reliably and reasonably predict future returns. Okay, now I'm going to leave that there, and I'm going to touch back on this in a second when we talk about the bull and the bear case. There's a reason why I'm sharing this, but I want you to think about this. When you think about your investments and your portfolio, I want you to think, are you invested into a business that's going to be here in the next 10 or 20 years and it's not going to be disrupted? Now, that's the thing about disruption and innovation, is it's very difficult to foresee it. To come back to what Bill Gates is saying, the key thing here, over time, most business assets will be affected by technology's broad reach, although Gillette, Coca-Cola, and See's Candy should be fine. So it's businesses, industries that are not so easily disrupted, okay? And that's what I want you to think about throughout this video. So now let's talk about understanding the industrial sector. So in the industrial sector, there's well over 600 companies that are publicly traded, and each of them are a bit different. You have the overarching industry or sector, which is industrials, and within that, you got a whole array of different companies. You got UPS, you got Raytheon, you got Honeywell and Caterpillar, and you got Boeing. If you just look at the top holdings in industrials, you can see that these companies are in different industries. UPS is in transportation, RTX, Raytheon is in defense, Honeywell is kind of all across the board, Caterpillar, those excavators that you see on the side of the road, very, very different. And when you think about waste management, yes, waste management is an industrial company, it's in the industrial sector, but it's in a very niche micro vertical within the industrial space. So when you look at where waste management plays, they're in the environmental and facility services sector, or micro sector within the industrial space. And you can see that this space, there's only 26 companies that play in this space, okay? And the largest ones in this space is, you got Waste Management, you got Republic Services, and you have a few others. Most people compare Waste Management and Republic Services, and to be honest, they're very, very similar. They have like a duopoly almost. It's the way that I think about waste management and RSG, I kind of think about Coca-Cola and Pepsi. That's really how similar they are. All right, now let's take a brief moment and let's look at the fundamentals that are important when it comes to waste management. So the first thing here that I want to look at is I want to look at the price to earnings ratio, the PE. So the PE for waste management, this is actually will be shocking to a lot of you. The PE of waste management is over 25. 25. You know what's crazy about that? Apple has the same PE as waste management. So this company trades at a premium. This is not like a sin stock or a utility, where they're trading at like an 8 PE. This is a 25 PE company. Okay, so really, really high quality. But here's the kicker. It's not just a fluke where just randomly the company is trading at a PE of 25, but rather, so when looking at their reporting, they report on non-GAAP. So most of the filings that I was looking at, it's all based off of non-GAAP. But you can see that their forward PE is just over 25. But here's the thing. Historically, their 5-year average has been 26.5. So in fact, historically, waste management, though it's trading at a premium, it's actually trading lower at a lower valuation than it has historically. Now, things have obviously drastically changed with interest rates and inflation being where it's at, but it's just important to understand that this company, when you look at it and you see, 25 PE, what's going on? This is actually pretty normal for this company. So in order for a company to demand such a high PE, the company has to be growing significantly. Okay, so let's take a look and let's look at their EPS growth. So this is their earnings per share growth. And what I'm looking for is this right here. So their EPS diluted growth forward, they have 11.5% EPS growth. This is actually really, really good for a dividend growth stock like a waste management. And here's the thing that I want to highlight. Over the last 5 years, their average has been over 10%. So this company, Waste Management, is growing its EPS on average over the last 5 years over 10%. This is really, really something special. Not a lot of companies at this stage, at this, where they're at in their maturity and their market cap, it's pretty impressive that they're growing their EPS by this percent year over year. The next thing here that I want to look at when looking at the fundamentals is I want to look at the payout ratio. So the payout ratio is the percentage that the company is paying out based off of their net income or relative to their net income. And you can see that the company here that Waste Management has, if we look at the non-GAAP filing right here, that they have a trailing PE of 46.5%. And it's pretty in line with their 5-year average of just under 49%. And I'll get into the investor presentation here in a second, and you'll actually see that management is targeting, they want a payout ratio between 40 and 50%. So this is right within line where they've been and where management wants them to be. Now, the last thing here that I want to show you here when it comes to the fundamentals is I want to show you something that's really interesting when it comes to the shares outstanding. So I want to go down here. Let's look at the balance sheet and let's take a look at their common shares outstanding or total shares outstanding. What I want you to look at is the total common shares outstanding. So what they're doing is they're not only increasing their EPS every year, they're not only increasing the revenue, which we actually didn't see, but they're increasing the revenue every year. And so they're increasing their top and bottom line. They're increasing their dividend year over year, but also in addition to that, they're also buying back shares. So they're reducing the number of shares that are outstanding. And so they're rewarding you as a shareholder in every way imaginable. They're growing their revenue, they're growing their earnings, they're growing their dividend every year, and they're reducing the amount of shares outstanding. This is a very shareholder-friendly management at this company that is rewarding shareholders in many ways. All right, now let's take a look at the dividend metrics here in Seeking Alpha. You can see that they have a forward dividend yield of 1.82%. This is with the dividend increase factored in. You can see the dividend payout ratio, all of that good stuff. What I want you to focus on is a couple of things. The first thing that I want you to consider is the 4-year dividend average. So I get asked this question all the time. Hey, Jake, is it a good time to buy this stock? Is it a good time to do this or that? Guys, I don't have a crystal ball. I have no idea what the market is going to do. I don't know. I'm not Ray Dalio or, Michael Burry, who's predicted every market correction since the dawn of time. And all the ones that didn't take place as well. I don't know. What I personally do is if I'm thinking about buying a stock, what I generally do is I look at the 4-year average. And if the stock is currently yielding higher than the 4-year average, I personally feel comfortable buying in at that price. Now, for example, if Waste Management had like a 1.5 or a 1.3 starting dividend yield, I would be cautious to buy Waste Management at that price because relative to historical performance, it's a little bit overvalued. And I don't have a crystal ball, but that's generally what I look at on whether or not it's a right time to buy a stock. And so by me making this video, I'm not saying, hey guys, this is the best time to buy Waste Management. No, that's not what I'm saying at all. I think right now, given the PE ratio, the forward PE ratio, and the 4-year average dividend yield, it's in line with historical norms. So you're not really getting a big bang for your buck, but you're also, in my opinion, looking at the metrics that we just looked at, you're also not getting in at a overly overpriced valuation relative to the last 4 and 5 years based on those metrics that we've looked at. But what I want to look at here is this right here. This is the most amazing thing here. This chart right here, if you don't understand this, if you're just learning about dividend investing, this is what it's all about. This is the the magic. Okay. So if you've been investing into Waste Management since 2018, you have a yield on cost of 3.5%. So if you bought into Waste Management 5 years ago, you're not getting a 1.8% dividend yield. You're getting a 3.5 on the money that you invested. Now, this is where it gets really, really exciting. When you look at 10 years, this is just mind-blowing. Over the last 10 years, if you would have been investing since 2013, your yield on cost is just under 8%. And this is the magic of dividend growth investing, is you're not just getting that, you see here that 1.82%. Yes, you're getting that today, but dividend growth investing is all about the growth over time. And going back to what we were learning from Warren Buffett and thinking in decades into the future, this 1.82% off of your original investment is going to compound and grow. Now, is it going to grow at the same pace as it has the last 10 years? I have no idea. No one knows. But if you have a long-term mindset and time horizon, these are the type of businesses that you want to look for that are growing their top and bottom line, they're buying back their shares, and they're increasing their dividend. And if we go back 30 years, you can see that the yield on cost has gone up and gone down depending on when you've bought into the company here. So when you buy plays a significant role in your future returns. Okay, so it's important that you don't buy a stock when it's massively overvalued, and you want to make sure that you're buying in at a fair valuation. All right, next here, what I want to do is I want to look at the dividend growth here. You can see that the dividend growth over the last 5 years is just under 9%. If you expand out over to 10 years, it's about 6%. But it really depends on which metric you're cherry picking and looking. If you look at the last 5 years, and 3 years, it's been closer to a 9%. If you look at the dividend history, this is what gets me really excited, is you can see that this company is well on its way to becoming a future dividend aristocrat, growing its dividend for 25 consecutive years. And so here's the thing, what I love investing into companies that are not yet dividend aristocrats because they don't yet in most cases, carry that premium. So there's a couple of things that what this is referred to. It's referred to as the Warren Buffett effect, where whenever Warren Buffett buys into a company, the valuation, the PE just skyrockets. That's what's called the Warren Buffett effect, but also the dividend aristocrat effect. Whenever a company, a business becomes a dividend aristocrat, the market places a premium on it because it's quality. It's a quality business. Okay. And so you think a 25 PE is high? Hey, I mean, it may go up, it may go down. I don't know, but I could imagine, this is me speculating, disclaimer, me speculating. I could imagine that once Waste Management becomes a dividend aristocrat, everything else remaining constant, I could imagine that a higher premium would be constituted. So we'll see, but that's just kind of where my head goes when I think about this company, where it's at today versus where it will be at in 5 years. All right, now let's take a look at their investor presentation and let's take a look at Waste Management, the company itself. And I want to walk through a few things here. When looking at how well they're positioned, they're all across the United States. They have 4 major business units. They have collection, they have transfer, they have landfill, and they have recycling. So this is what I really like about Waste Management is they're very well diversified. So if one business unit is struggling, they have other units that they can rely on. And that's why a big reason why they were able to do so well during the pandemic, because they were not just focused in one area. So you have other companies, for example, that were just focused on commercial. And when all the office buildings shut down and closed during the pandemic, well, what happened to those businesses? Well, they struggled, obviously. But because Waste Management is so well diversified, they're not just centered on one segment. You know, they're not just on commercial, they're in real estate, they're all over the place. They were able to cushion that blow from the pandemic. So 54% of their revenue comes from collections. And I'll get to that just in a second, what that breakup looks like. 9% is coming from their transfer business, 19% from their landfill business, 8% from their recycling, and then 10% from other business units. So where I see the growth for Waste Management is in their recycling. I think the recycling piece is going to continue to grow. I think, you know, when you look at this year over year, so this says 2021, it has not changed much over the last couple of years. So this is not a company that's, you know, one year to the next, this is going to be 54, the next year it's going to be 75. Like it's a very slow moving business. Okay. And there's a lot of infrastructure needed. And that's why you don't see a lot of that disruption, because the upfront cost to get a business like this up and running is so high. And that's why these incumbents, like a Waste Management, maintain their pole position because of the upfront cost that goes into getting these operations up and running. Now, I know that was a mouthful, but at the end of the day, it's a good thing if you're invested into a company like Waste Management, because they're not going to be so easily disrupted. So when you look at their collections business unit, this is their largest business unit. You can see even in this segment that they're very, very well diversified. You can see that this segment is diversified into a handful of different micro, I guess, or sub sections. And you can see that the public sector represents the largest percentage: manufacturing, retail, construction, et cetera, et cetera. So this right here, this offices and venues, when the pandemic hit, I was thinking to myself, oh, shoot, Waste Management is going to get really hit, and you know what's going to happen. But they're so well diversified that it didn't really impact them at all. So when looking at the solid waste and recycling market as a whole, you can see that, you know, the TAM, or the total addressable market, makes up a few different players. So you got regional or local municipal players. That could be like, for example, where I live in the city of Austin, where the city handles that themselves. You then have Waste Management. You have Republic Services over here, RSG, that make up a larger percentage of this market. And so when it comes to Waste Management, how they're growing largely through mergers and acquisitions. So when you think about the potential growth for Waste Management, it's not going to be just through, okay, we're going to open up a new landfill, a new plant, but a lot of it's going to come strategically through mergers and acquisitions. And then here really quick, this is important. I mentioned this earlier. The management company targets a 40 to 50% payout of their free cash flow. So they're looking to maintain that. So if you see that their payout ratio is increasing, 1 year, they may not be able to grow their dividend as quickly, but here's the key thing is they're targeting this so that they don't overdo it, right? So that they don't run the risk of having to cut it. So keeping that range of 40 to 50% is very conservative in my opinion for this type of business. And then lastly here, looking at this graphically, you can see how they've maintained that payout ratio. And despite having a higher payout ratio in 2012, they did not cut their dividend. They had enough cushion and buffer, and they were able to decrease their payout ratio by increasing their revenue and increasing their earnings per share. Next, I want to go and I want to take a look at what Morningstar is saying, what analysts are saying when it comes to waste management, and I want to look at the bull and the bear case. So really quick here, let's take a look at what the bulls are saying. They're saying that, the bulls are saying that they have a stable business model and they have a wide economic moat, and it's rooted in their intangible assets and their cost advantages. So the infrastructure that they already have, their management is what the bulls are saying, is very shareholder friendly. They're also a very strong ESG play. Now take that with a grain of salt, whatever it is, what your opinion is on ESG, but they're the real deal when it comes to ESG. They're actually doing what it should actually look like, in my opinion. So what are the bears saying? There's three things that stand out for what the bears are saying. So they're saying, first off, that acquisitions could become more complex, more difficult, and so their growth rate may be impacted that way. Okay, sure. The next thing that the bears are saying is that the recycling segment, that's kind of where hopefully their growth will come from, that their operating costs could rise. And then the third thing here is that U.S. municipalities are pushing more for different type of waste reduction and recycling, and this could pressure waste management's margins over the long term. So it's not something that's going to happen overnight, but it's something that could gradually occur as more and more states and cities start to, require different approaches to how they're going about with waste reduction and recycling. And then lastly here, the economic moat here, what they're saying is, I think this is so interesting. And it comes back to what I was saying earlier, the article that we saw from Bill Gates, is that we assign waste management a wide economic moat because we have very high confidence in the firm's ability to generate excess returns over the next 10 years, and we think it's more likely than not that excess returns will persist over the next 20 years. This is why I invest into waste management. It's a business that you can reliably and reasonably predict what will happen over the next 10 and 20 years. And I, as a dividend growth investor, someone who's looking to live off of my dividend income from my portfolio, I absolutely love this. All right, lastly here, let's take a look and let's compare waste management versus the S&P 500 and versus SCHD. So we're going to do this in the charting field here in Seeking Alpha. We're going to take a look at the price return plus the total return with the dividend reinvested. If you wanted to compare additional ETFs or different stocks, you can use the edit comparison here. You will need Seeking Alpha Premium for this. If you want to sign up to Seeking Alpha Premium, I will leave a link in the description below. You'll be able to get 50% off your subscription with my link in the description below. Okay, so let's take a look at this. Let's see, over the last year, you can see that waste management on a price return basis has outperformed the bunch here. So let's take a look at the total return as well. So that once again, the total return is the price, the capital appreciation, plus the dividend. Okay. And the dividend, whether it's reinvested or not reinvested, it's still part of the total return. So you can see here that waste management over the last year has outperformed the group here. Let's look over the last 3 years. You can see that SCHD has outperformed. But if you go back a little bit further over the last 5 years, you can see that waste management has outperformed the S&P 500 and SCHD. Now let's go back over the last 10 years, and you can see over the last 10 years, Waste Management has more than doubled the S&P 500 and has done significantly better than SCHD. Now what we're going to do, because SCHD has only been around for about 11 or 12 years, I'm going to remove SCHD and I want to look at Waste Management compared to the S&P 500. And if we zoom out even further, back to 1993, Waste Management has greatly outperformed the S&P 500 on a total return basis. Now, this just shows the power of investing into high quality businesses, companies that are in industries that are not as easily disrupted, that maintain that pole position and have that economic moat for decades. And you can see if you've been an investor since the early 2000s, up until about 2014, nothing really happened. It just kind of stayed flat with the market. And that's why, coming back to what I was saying, the quote from Bill Gates, referencing what Warren Buffett was saying, you really, if you want to be an investor, and if you really, especially if you want to be a dividend investor, you have to have a long-term mindset. If you have a long-term mindset and you're thinking in decades, it's very difficult to fail if you're investing into high-quality businesses like a Waste Management or an ETF like an SCHD that's focused on a high-quality index. It's very difficult to fail as an investor if you're thinking in decades. Some years you may have to be more patient than others, but if you think in decades, we have seen time and time again that the market rewards investors that think long-term versus short-term. Thank you so much for watching, everybody. I hope that this video was helpful. I hope that you learned something new, and I'll catch everybody in next week's video.
So please whatever. I want to reach 1 million likes. Okay, thank you.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.